Good morning, everyone. Thanks for joining today's webinar. As you see, the topic for today's webinar is how Indian equities look right now. So, in this webinar, we'll be touching mostly on large cap and mid cap sector, by the way, right? So, it's not anything particularly about investment, and so just for learning purpose right now, how the Indian equities look right now, how large cap specifically, followed by mid cap, right? So, yes, we can start today's webinar. So let's start today's discussion by looking at something very important that's happening beneath the surface of our Indian equities market. So this is something this slide which talks about the ownership. So specifically, who owns Indian equities today and how it has changed over time. Right. So what you can see here is that the FIS ownership in Indian equities is right now at you can see at somewhat around decadal low. So currently it's around 17%. But while when you see the DIS ownership, it has steadily risen to around 19%. We have gone when we go back like 10 years back, FIs used to own more than 22% of the market. But right now, when you see the gap has gradually narrowed, and today, for the first time in many years, domestic investors actually own more Indian equities than the foreign investors. Now, why this is very important? See, traditionally, Indian market were heavily dependent on foreign flows. Yes. So whenever FIS sold aggressively due to the kind of interest rate, dollar strength, geopolitical risk, and so Indian markets used to correct sharply. But what has changed over the last decade is the structural rise of domestic capital through mutual fund SIPs, insurance companies, pension companies, and even the retail investors have become a strong counterbalance to this what foreign selling. So this chart so clearly shows that while see the FIS have been reducing exposure over the years, DAs have been steadily increasing this kind of stake. You can see right. So almost in a straight line, this reflect kind of a major shift. Like it can be something like a maturity of the Indian market. So when the domestic money today is not a kind of a hot money, it's a kind of a long-term patient capital. So the important thing right now, why we should look right now is why FIS have reduced their ownership. It's not because India's growth story is weak. In fact, India is one of the kind of fastest growing economies right now. So the reduction by FIS has the ownership is largely due to this kind of global factors like this US interest rate stuff, better yield available in developed countries, for even the currency stuff, even the global risk base and so. But FIs move money globally, not only emotionally. You should look this because they chase relative returns. They'll see how the other kind of global markets are doing, and so even China, and so this everything plays a big role for in the perspective of FIS. So what's encouraging is that despite FIS ownership falling to the decadal low, Indian markets have continued to hold up. So this itself tells you something very much important is the market's foundation has become very stronger. Yes. So corrections are getting absorbed even much faster. Volatility is getting more smoother, and long-term investors are being rewarded in a good way. So how we can interpret this as an investor today? See, low FII ownership means a lot of pessimism's already been priced in. You should understand that. Second, what you should see is that if and when the global conditions improve, like the interest rate cuts or the dollar weakening issue gets sorted, FIS don't need to fall in love with India again. Yes, they just need to come back like a kind of in a neutral state, and even a small reallocation from global funds can create a meaningful upside. Because their ownership is now currently very low. At the same time, this strong DI participation tells us that India's kind of equity study is now internally very much good funded, not dependent on any kind of foreign approval. This makes Indian equities more resilient and kind of more structurally strong than ever before. Even when you see the decadal history, India is now in a good state, I would say. So as we discussed how Indian equities look right now, keeping this framework in mind, let's see how we are in a phase where the foreign ownership, even you see, when the foreign ownership is low, and then DAs are keep on pumping in money. You can even look in another aspect also. So you just think on September 2024, Nifty has reached its all-time high, right? But right now, at the time where right now also is Nifty is trading around 26 26,000 to 26,200. Now also we are in the same range where we have been like a year back. So now you think in 2024, the FIS holding was very high. Only through that much FI holding, we are able to reach that all-time high. Right now, even we reach that same all-time high without the help of FI. So you can see how the drastic shift we have kind of undergone a big change. So this shows how our DA is more powerful in the current equity market. Yes, now we have seen who owns the Indian market today. So let's now zoom out and look at something even more important, how markets behave over longer periods of time. So this slide is very powerful. Yes, see, because it tells a simple but often forgotten truth. Volatility has always been a feature of equity market. But so as growth also, right? So what you see on this chart is in something like a long movement of the BSE sensor. See, starting from around the mid 1980s all the way till 2025. Along the journey, the chart highlights almost every major crisis like scandal, war, kind of global events that investors are more worried about at the time point in time and so. So right now we can just go something in a much slower way into the every events right now. So around 1980s and 1990s, we can see that the Iraq-Kuwait conflict, this domestic political instability, even the investors at that time believed that the economy is going to fragile. Then came the Harshad Mehta scam, then followed by the Bombay bomb blast, and later the Asian financial crisis. Each even created fear that this time this is different, like that, right? So moving ahead, we saw the dot-com bubble, the 9/11 attack, then Ketan Parekh scam, then the global financial crisis of 2008, which many of us still remember so much, right? So at that point, people genuinely believed equity investing was finished. The census fell sharply, businesses collapsed, and the headlines were extremely negative. Then again, when confidence returned, we saw euro kind of dead zone, the taper tantrum, the demonetization, the ILFS crisis, which is followed by this COVID-19 pandemic. So national-wide lockdown, geopolitical conflict, this interest rate hike, and more recently, this global wars and geopolitical tension. Now, here's important observation. Every single one of these events felt like the end of the world at that moment, right? But none of them stopped long-term wealth creation. Despite all these shocks, look at the direction of the market over time. The trend is clearly upward. Market don't move in straight line, but they reward patience, not prediction. This is very important. This is why volatility should not be seen as a problem. It is like a price you pay for the equity return. See, if the market were smooth and predictable, there would be no excess return, right? See, volatility creates a discomfort, but it also creates more opportunity. You should look that in that way, I would say. So another important lesson from this chart is about the time in the market versus the time in the market. So if an investor kind of try to exit during every crisis and re-enter later, the chances are kind of it would be like he missed the strongest recoveries, which should often come when the kind of the sentiment is still weak though. You can see that when he missed the opportunity, like he come out during this crisis, and so when he re-enter, he's not going to get the recovery benefit. That's the thing. So also when you notice something here, when every crisis market, see, just not just recovering, they recover to a higher kind of higher basis. That's very important. That's because India's growth drivers like population, mainly consumption, then the growing entrepreneurship and the capital market participation continues to strengthen over time. So for investors today, especially those worried about short-term correction, kind of the slide, kind of sideways market, volatility is not a kind of a signal to exit. It's a reminder to stay aligned with your long-term plan. The biggest mistake in equity investing usually happens not because market fault, because people lose patience at the wrong time. Yes, this is very important. So when you hear negative headlines or see a sharp market moves, remember this slide. Every red arrow on this chart once felt scary, but today they look like small bumps, kind of in a long journey upward. So as we see what's everything. So in later slide we can discuss on how this can be seen through long-term goal-based investing, asset allocation, and so. So now, one of the important slides of today's session. This is the chart shows the Nifty 50's calendar returns in green and their maximum drawdown within that same year, which is shown in the blue color, right? So together they tell us that true story of equity investing, not just returns, but the kind of the pain investor has to tolerate to earn those returns. Most people look at annual returns and think, oh, investing is smooth, but this chart reminds us that every kind of even in every good years, market falls sharply at some point during that year. So when you see particularly, take a kind of you can see a strong return like in 2003, 2009, 14, 17, even 2021. In many of these years, the index delivered 25, 30, even 70 plus percent returns, right? But look at the drawdowns during those same years, 10%, 15%, even 20% correction happened before the year ended positively. So the key message here is simple. Drawdowns are no exceptions. They are part of the process. So let's talk about the bad years as well. So you can see particularly in 2008, the Nifty fell over 50%, one of the worst years in the market history. Same in 2020, you see, during COVID, market corrected something close to 38% at one point. At those moments, fear was extremely high and many investors exited thinking market delivered one of the best years ever. Same way post 2020, you can see market moved to the new highs within the relative short period. This is like a cyclical nature of equity markets. So another important observation is there is no single year without volatility. Even in flat or low return years like 2015, 16, 17, so market still went through meaningful drawdown. This tells us that see that's what it's something like a perfect low year risk to invest in unrealistic. That's what I want to say. So such year doesn't exist. I want to say. So what does this mean for investors right now? See, first, if you are investing in equities, you must mentally accept the drawdowns of 10, 20% as normal. And occasionally, deeper corrections are part of this long-term wealth creation. Trying to avoid every fall usually result in missing the best recovery phases. Second, this chart highlights why time in the market is more important than that timing the market. Investors who kind of stayed invested across every cycles benefited for a long-term compounding while those who exited during the drawdown often logged in losses. So then, see, this also explains why SIPs work so well. So this chart is a good example. So when market correct, SIPs automatically invest at lower levels, improving the long-term returns. Many investors who feel uncomfortable during the drawdowns don't realize that this phases actually help long-term investors if they stay disciplined. Finally, this chart reinforces why asset allocation, emergency fund, and goal-based investing is very important. When your financial plan is structured properly, drawdowns don't force you to sell at the wrong time. So when markets correct, instead of asking why is the market falling, a better question is my plan strong enough to handle this? That would be a good way to tackle the situation because history clearly shows us the one thing: market reward patience, but they test it very regularly. So now let's look at the slide. See, you can look very carefully into this slide. So because this table is kind of captures one of the important truth of equity investing. So leaders in market keeps rotating. It's kind of something you should keep in your mind. So what you are seeing here is the performance of market indices, factor indices, even sectoral indices across different time period. So from short-term performance to long-term return. At the first glance, it may look complex, but the message is actually very simple. Let's start with the market cap based indices. Over the long term, say 5, 10, 15 years, large cap, mid cap, small caps all delivered respectable returns, but not in the same period. See, so there are phases where mid caps and small caps outperform sharply, and there are phases where they correct much more than the large caps. So, for example, notice how small cap and micro cap indices have deeper drawdowns from recent highs, while the large caps have been relatively more stable. So this tells us something that kind of see. It's kind of more like higher return potential always come with higher volatility. So it's kind of more mixed, I would say. So when some small caps are doing good, they look some very attractive, but then sentiment should changes, they fall much faster. This is why position sizing, everything plays a important role, I would say. Now look at the factor based indices like value, quality, momentum, low volatility. Each of these style perform well in different market environment. So when you see momentum does well when the trends are strong, quality performs better when the markets are like uncertain, value do well when there's a good shine when the market meets a reward. So the key takeaway is that no single factor works all the time. So moving to the important thing right now is sectoral indices. There are where investors often make the big greatest mistake, I would say. You will notice that sectors like IT, metal, reality, energy, PSU all had phases of strong outperformance and phases of underperformances also. So for instance, when you say IT and metals, they have seen sharp cycle linked to the global growth, currency movements, same way defense and PSU theme delivered kind of strong return. So see, I think the Tejas crash, what happened, so that had a big impact in the defense sector. So everything has a volatility and a big role to play. So it doesn't mean that they all kind of will be there same forever. Every sector will eventually cool off, and so this is where many investors go wrong, chase the best performing sector of the last 1 2 years, assuming it will continue. But markets don't work that way. By the time the sector looks more attractive in headline, much of the returns are already behind. It is already been factored in. That's important to be taken. Um so even if you see clearly that the returns are scattered across sectors and market caps over time. So see, there is no permanent winner. This is exactly why, see, you should know how everything works. So this is a good chart. I think you can see where how everything has been more into scattered nature of the equity market. So now this slide is one of the kind of good, more powerful visual slide, I would say. So because it shows the reality that every long-term investors must accept that sectoral leadership keeps changing every single year. What you are seeing in this calendar year ranking for sectoral performance, each column represents 1 year. And see, the sectors arrange from best to the worst, but see, you notice that one thing very clearly, no sector stays on the top consistently. So even same way, no sector stays at the bottom forever. So they see like metal, PSUs, reality, IT, pharma, each sectors had a year of exceptional return, followed by a year of sharp underperformance. See, this everything I'm showing is only history. Nothing, it's like forecasted and so sectors that deliver 60-70% return in 1 year can easily become one of the worst performer in the next year. So this tells us two important things. First, see, sector timing is extremely difficult. You should understand this is very difficult. By the time the sector becomes more popular in news, WhatsApp or even social media, most people kind of become upsiders, usually behind the scene, I want to say. So second, market rewards only patience, not like this prediction, oh, this sector is doing good, we can invest in that. If you are in that mindset, you are not going to get. In long term, you are going to be a kind of a person who is being the loser, I would say. So if you look at this table even more careful, the color keeps changing every year, which means that leadership rotates based on economic cycle, interest rate, global demand, policy changes, earning growth, and so no one can forecast this more consistently. Even see, this is why the concentrated sectors bet often disappoints investors. See, they work brilliantly for short pace. I agree. But when the cycle turns, returns disappears adjust quickly. On the other hand, investors who stay diversified across they know how to manage this stuff, having a good professional guidance, they can overcome this. Otherwise, it will be like a more kind of a tackle situation. So yes, right now I'll hand over to Subash sir to take over the mid cap sector right now. So you can take on.
Hi. Actually, today I'm going to speak, just give an insight how the mid cap has been moved in the longer run. Actually, the mid cap, everyone says it is it is a risky index, and then every all the stuff it has been in the market. But I'm saying over the longer run, on last 25 years, it has given 19% CAGR return. So I'm going to break the chart into six different parts. Okay, so from 1999 to 2007, there is not big events happened in the market. So it has been very slow and steady. So after 2007, to 2008, there is a global crisis where the peak is 9,000, the index value, and it has gone up to 4,000. That means 50% correction. But that once market has 9 to 13, it was a biggest return as we have gotten that year. So because why I'm saying is, if you invest in longer run, we will be getting a better return. So you should not fall on the sentiments. So all the bad news is coming in the markets. So you should not depend upon news as sentiments. Only thing is you have cautiously invested. If you are in that pace, you will be getting a better return, and it is a risk to reward return. So coming to 2014-18, there is a breakout. Again, it has been there is a downfall. When that time the index has been in 10,000, and it has been moved up to 20,000, the index value. That is again another 50% return we have got. So again, I'm saying is the longer run it will be the better return. For example, someone if in COVID phase, we have almost came back to the 9,000 levels. So again, there is a steep and steady recovery in another 7 to 8 months that has given 46%. See how the market and index is performing is when you are in when there is a sentiment role plays. For example, everyone says market is correcting, so we have to get out, we have to exit. But when you are steady and go for the SIP, like investing in that pace, I'm sure you will be rewarded with the better returns. So even what this is a mid cap, even it is in large cap or small cap, whatever the index you speak. So you have to be steady and cautiously investing. So it's a better option is start doing SIP, and then study and focus on the return and asset allocation, goal-based investing. So that will be helpful in longer run. Go to next slide, Ram. So this is one of the best evidence. So this is in Nifty Midcap in 100 index, 12 months rolling based return. So each and every year, how much in that 12 months, in every year, the 12 months, how much of positive return and negative return we have been occurred. So for example, 2000, if you see 50-50, we have been in positive side 50 and negative side 50. So overall return is 0.9%. So if you see, those many pains is going ups and down, but end of the day, the reward will remain higher. So for example, if I say in 2009 to 13, if you see, there is a 9 months of positive return. Again, 2010, there is a 7 months of positive return. Coming to 2018 to 20, there is a in 2020, everyone says it is a global crisis, but end of the year, significantly we have recovered, and it has been 9 months of positive return. 2021, it's a strong upward trend. It is 11 months, only 1 month of a negative. So everything goes beyond the sentiment. Only thing is you should be stay invested and then focus on longer run. So if you focus on longer run, the reward will be better. So this is mid-cap year-on-year performance. And so mid-cap year-on-year performance is simply, so all 2008, 11, 15, 18, 20, if you see, all those years are a very bad years. But each and every 2 bad years, there is a steady good years of 5 good years. If you see 2000 and 2001, there is a bad year. But 2003, it was 138. It is an absolute basis return. 2008, the global crisis happened. It is 50% negative. Again, it has been recovered by 100%. 2011, that is a 31% of a negative return, but it has been recovered again by 39%. 2013, there is a slight drawdown. but it has been recovered and it has been delivered 50% of absolute return in last in that 4 corresponding years. 2018-19, again it has been a bad years because of COVID impact. So in that, after that, there is a steady recovery. It has been 22%, 46%, again it has been 30, 36, like that. Each and every year we have delivered a good return, and two consecutive bad years, there is a steady and very good next 4 to 5 years return. Uh, Nifty 100 index exhibit, Ram, can you just go previous slide, Ram? So, in occasionally there is a deep correction. So, over a longer run, the midcap has been rewarded the investor who remained patiently and disciplined investing towards the market. So, here we have to be very cautious on sentiment, discipline in investing, and then if you address those two things, you will be rewarded with the better returns. So my best advice is stay disciplined in investing. Don't fall on the sentiments. So if you address those two things, you will be rewarded with the better returns. Whatever the index, this is basically I'm giving you an insight. But if you are investing in large cap, small cap, or any other asset allocation wise, goal based investing, but it should be disciplined, goal based. Will come every day. There is news. React. It won't react. That the conducting. You are not depending upon the sentiment. So if you know the sentiments, this is the another evidence. So in Nifty Midcap 100, in 3 years, if you are invested, the average return is 19%, and 5 year is 18%, and 7 year is 17%, and 10 year is 16%. See how the returns is growing. If you are in the longer run, these are all compound annualized, and then this the maximum return you will be getting is 28%, and the minimum, there is no negative return in last 10 years. So that is where we are saying the longer investing will be rewarded more. So total number of occurrences, there is a consistency. So coming to consistency, wherever we have 96% of a person, 96% of the times we have given above 8% return across all the index, Nifty or the Nifty 5, and this is be based on the consistency basis. We have in the mid cap has given the better returns, 96%. The below average is 55%. So always when you are going in the longer run, you will be not participating in the negative part of a return. Only the positive side you will be facing. So better. These are all only the evidence, and these are all the only hindsight in. So I'm giving you the best advice. That's it. So we are not saying we should invest in this or that, but this is an best evidence we are showing that. So if you are in the longer run, you will be getting a better reward. So longer run, it should be disciplined in investing, stay focused, and then start doing the SIPs, and we will. The goal-based investing and asset allocation, everything will be done. Over to Ram.
Thank you, sir. Thank you. I'm sorry, guys. There was some network delay, so there was kind of a change in slides, and so yes, thank you, sir. So yes, we can now move on. So now that we have spoken about how large cap on equity as a whole and how mid cap has worked. So now let me introduce you to how we help investors to navigate this journey in a structured way through M2W, that is Milestones to Wealth. So M2W is not about chasing return or overreacting to something like market noise, and so it's a kind of a transformative wealth creation journey designed to help investors to think big and reach their first grow with confidence and clarity. So at its core, M2W has a very simple mission: convert financial dreams into achievable milestones. Whether someone starts with 5 lakhs, 10 lakhs, or even less, we focus on building a disciplined path towards long-term wealth instead of a short-term excitement. So what M2W gives is strength in experience and scale. We bring 10 plus years of investment thinking, managing over 1,100 crores of assets, and we have supported more than 6,300 successful clients through multiple market cycles, bull market, bear market, and long period of consolidation. This experience matters because wealth is not built in a perfect kind of a market. It's built by staying consistent during the imperfect market. So MPW combines goal-based planning, disciplined SIP investing, proper asset allocation, regular reviews. So investors don't feel lost when their markets are more volatile and flat. So at this point, as natural, question is like who are we and so how we help investor to do this, right? So MPW is a kind of I thought MFD's initiative where it's created with the one clear objective to help investors to unlock the true power of mutual fund investing. So not through shortcuts but through kind of a structured, disciplined, and long-term thinking. So behind M2W, so since being an MFD distribution route, it's kind of we have over 16 years of experience in mutual fund research. This experience spans multiple market cycles, bull market, sharp corrections, global crisis, and a long period of sideways market, as I said earlier. So that's the thing. So, see, we do differently. Like, see, we focus on customized mutual fund portfolios, not like one size fits for all solution. Every investor has a different goal timings. So see, like they come in a different time. They have some risk comfort, like they have a different risk taking capacity. They have different cash flows. So portfolios need to be reflect that in reality, right? So our approach is like more multi-asset and a milestone based on. So instead of asking which fund will perform best this year, we ask a better question: what is the goal? When is the money needed? Like how much risk is appropriate along the way? With MPW, the focus stays firmly as a smart strategy, risk control, and kind of more steady participation in the market. So we help the investors to remain invested during the volatile and don't lose direction during the corrections. So in short, we don't promise perfection, we promise process. That's very important. And over time, a strong process is what converts investing into long-term wealth. And when we move to our philosophy, so see, first is prudent risk management. We believe protecting capital is important thing as growing it. So this means avoiding unnecessary concentration, managing downside during volatile phases, and ensure investors stay invested even when the markets are uncomfortable. So as I stated earlier, we are kind of a decadal kind of research experience. So we are more research driven approach. Our decisions are not based on tips or market noise, but a deep continuous research across funds, asset classes, market cycles. Research gives kind of good conviction. Conviction gives you good discipline. Then, as stated by Sir, also goal-based investing, we don't invest money in isolation. We invest for life goals. Whether it's like a child's education, buying a home, retirement, every rupee has a purpose and a time horizon. Finally, it's a dynamic asset allocation way how we work. So market changes, cycle shift, portfolio must adapt. We act kind of a good balance between equity, debt, other precious metals, and other asset classes, and so that the risk and opportunity remain aligned with each investor's journey. Together, these are the four pillars that ensure steady, kind of more sensible wealth creation without chasing a shortcuts, right? So yes, as we come close to today's session, I want you to look at this slide. So see, you can see carefully in this one. So because this is not a chart, it's like a journey. So as I stated, around 6,300 plus investors are already walking in this path with M2W. They don't start with the growth. They started kind of like exactly where most of us are. So with small discipline step from self-starter who are on the bracket of 0 to 2 lakhs, then to go getters, so about 2 lakhs, then achievers at 5 lakhs, then to warriors at 10 lakhs, then sharpshooters at 25 lakhs, then masteros at 50 lakhs, then ambassadors at who reach the 1 crore. So every level here represents patient process and persistence. So the most important takeaway is that every ambassador was once a self-starter. So the difference was not timing the market, but staying committed to the journey. So MPW is not a quick win. It's like about building your first grow the right way. If you are ready to start or a move, you can just like see, you can just have a good gradual move to the next milestone. We are here to walk you with your toward the journey. So yes, thank you guys for attending the webinar and welcome to the MPW way of building wealth. Yes, thank you everyone. Thank you everyone for joining today's webinar. So we can catch up in the upcoming webinars. Thank you guys. Same way, Happy New Year for everyone. Advance.
Happy New
Yeah,
Year
thank
for
you guys.
everyone. Thank you.